Hi, everybody. Welcome back. This is a quick video showing you how to go through the participation activity for Econ 1A, looking at money and monetary policy. And so for this, what we're going to be using is the graph of the federal funds rate. We want to remember that we have three tools that the Federal Reserve can use to target the federal funds rate in order to try and affect the money supply and affect the economy. And so we have the market for the federal funds rate, and this is on your graph, on your assignment. And so we have the quantity of federal funds, and then we have the federal funds rate here. And that's an interest rate that the Federal Reserve targets when they're trying to engage in monetary policy and influence the money supply. There's going to be some demand for federal funds and some supply and some current equilibrium. Right? So far, so good. All right. Currently, the federal funds rate is at about what, 5% or 0.5%? It's pretty low. And so we have two things we want to do here. We want to look at two choices the Federal Reserve can make and how they're going to affect the federal funds rate. So the first thing we're going to do is question one. Question one says, now that we're in an economic recession, the Federal Reserve wants to lower the federal funds rate to try and stimulate the economy. And so they want to do that using open market operations. And so we want to say how that would happen and then graph it. Remember, open market operations is the selling and buying of bonds. And it's tricky. It's a little bit of a weird one because what we're talking about here is changing the liquidity of reserves for banks by buying and selling bonds. And so what you want to remember is if I'm buying, I'm taking assets and I'm putting money in. If I'm selling, I am taking money out of the market and putting those assets in. So that's going to reduce the money supply. So if I want to reduce the money supply, and that's going to raise the federal funds rate. If I want to increase the money supply, that's going to lower the federal funds rate. And so you kind of have to do a little bit of backward math here. If we want to lower the federal funds rate to some lower amount, we want to increase the supply of federal funds. Let's say we want to lower it to 25%. So what we're going to want to do to increase that supply of federal funds is we want to put dollars in. So we have to take bonds, those assets out. So we want to buy bonds in order to shift out the supply of federal funds. That's going to have the effect of lowering the federal funds rate. Okay? So buy bonds, cash goes out, supply of money goes out, interest rates go down, the economy speeds up. It's like pushing the gas in the car of the economy. Okay? Hopefully that makes sense. The whole point of this is to practice this stuff because it's a little bit weird. The more we practice it, though, the better we get at it. Problem 2 says, okay, we've done that. Now let's do something different. So now what we want to do is look at a market situation where the central bank wants to slow the economy down. And that means they're going to want to do the opposite. Now they don't want to lower the federal funds rate. They want to raise the federal funds rate. So what they're going to want to do to slow the economy down is they want to change the reserve ratio. So right now, the required reserve ratio is 0.05, meaning banks keep 5% of every dollar deposited as reserves. If the Federal Reserve wants to increase the federal funds rate, how would they change the reserve requirement and how would it affect the money supply? So We want to increase the federal funds rate by changing the reserve requirement. So what we want to do then is shift the supply in to get a higher federal funds rate. Maybe you want to go up to 1%. Let's just do that. That's easier. 1%. So if we want to decrease the amount of money moving through the economy, we know that the required reserve ratio is directly related to the money multiplier. If we want the federal funds rate to go up, that means we want less supply of money in the economy. So we want the money supply to be smaller. Do we want the money multiplier to be bigger or smaller if we want the supply of money to go smaller? We want it to be smaller. If we want the money to supply to go down, that means we need a smaller money multiplier, which means we need a larger reserve ratio. So maybe I want to turn the reserve ratio requirement to 10%. That's going to reduce the money multiplier, reduce how much money banks can loan out, reduce the money supply, shift that supply of loanable funds in, and get us to a higher federal funds rate, a higher interest rate. Does that kind of make sense? The goal of this activity is to practice these ideas. We're going to keep talking about these tools for more than just this week. So they're going to keep coming up and we're going to keep getting opportunities to practice. But this seemed like a good opportunity to practice it in a safe, low stakes way and get a little bit of another sense of how they work. Okay? The third tool we didn't talk about was the discount rate. That's the interest rate the Federal Reserve charges banks. If the interest rate goes up, federal funds rate goes up. Discount rate goes down, federal funds rate goes down. So the mechanism is really clear in that one, and that's why I didn't pick it for the one we practiced. Hopefully that makes sense. Let me know what questions you have. Make sure to turn in this participation activity, and I'll see you all next time.